Good afternoon, everyone. Thank you for joining us for our webinar today, where we're going to be giving you an update on state and local taxes. I hope you're as excited as I am. My name is Mark Heath, and I'm Partner and Director of Tax Services here at McConley & Asbury. With me today is my esteemed colleague, Lindsey Waltemyer. Lindsey heads up our state and local tax practice and is a tax manager here with the firm. If you don't know McConley & Asbury terribly well, we are an accounting and business advisory services firm with offices in Camp Hill, Lancaster, and Bloomsburg. We provide a range of services to organizations across a wide variety of industries, all of which you can see on the screen there. We encourage you to check out our website and soak up all the valuable information there. If you've joined us on past webinars, thank you for coming back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going around in the business world. Be sure to check out our website to catch past presentations, as well as current information through our blog. If you do have any questions for us during our webinar today, you can submit them through the built-in questions function in the webinar control panel, and we'll do our best to answer them during or after the webinar. If you are looking for CPE credit today, and good grief, if you're a CPA, I hope you are, please keep in mind that there will be 3 polling questions throughout today's presentation. You'll need to answer all 3 of those to get your certificate via email a few weeks after the webinar. And I try to be as obnoxious as possible when those polling questions come up, because I get it, it's a webinar, you get distracted. So we will try to bring your attention back to the screen. With that said, I am going to turn it over to Lindsey.
Thank you, Mark. And that just gets me thinking on the slide about all of our different industries, how state and local tax really touches all of those industries. So we have a pretty packed agenda today. I think we'll spend more time on some topics than others, try to really focus on hopefully what's important to you. But we're going to start here with the state impact of federal changes, as well as some COVID relief updates and how states treat those. Move on to pass-through NAD taxes. I expect this will take up some of our time, as this is a really hot topic right now. We're going to touch on some work from home nexus, the continuing impact of Wayfair and where things stand now, and then move on, if we have time, to the Pennsylvania budget and how PA compares to other states. So as far as federal changes, we've had a lot the past couple of years, starting with the Tax Cuts and Jobs Act. And I've spoken more in depth on previous webinars how you have to make a determination on how a state is going to react when the federal code changes. So certain states have fixed conformity, others have rolling. It all you have to look at all of that to kind of determine what a state's going to do. So this is just sort of a reminder, when the federal government makes changes, we have to then determine what we need to do for the states. Most of these topics are sort of old news at this point. We all dealt with economic stimulus payments, the NOL changes, interest limitation, not anything new, but just kind of something that we always have to keep an eye on as states sometimes come out with additional guidance. The ADS depreciation update is a new one. The government just came out with RevProc 2021-28, and that gave guidance on how to make the previously required ADS depreciation update, and this is for electing real property trades or businesses. So I could go really in depth into that, but I don't think it's really under the state and local tax webinar. So if that's something you are interested in, feel free to reach out to myself. So I'm going to let Mark talk a little bit as our PPP loan expert here on that topic in general.
Well, this feels a little weird with talking about this without Dave on here with me. As everybody knows, Dave likes to talk a lot, which comes in very handy when we talk about PPP loans. So as you can see on there, the program ended at the end of May. Quick highlights in case you've forgotten. The income is not taxable at the federal level, but the expenses are deductible, so you do get that double dip. And the majority of states did end up conforming to these federal rules, which just means they're just following federal. You get the same benefit for state as you do for federal, including Pennsylvania. Couple outliers there. I think this was kind of a political challenge when, obviously during the very trying times economically and otherwise, when the feds kind of said, hey, this program was intended to not cause any kind of tax liability. This money was for you to use to keep your business going. Most states were like, yeah, we should probably just follow that because we don't want to make anybody mad. But as you can see on there, Florida, Utah, Rhode Island cut it off at 250. So if you got over 250, you're not going to get that full benefit there. And then California, Hawaii, North Carolina, and Virginia cut it off at $100,000. We do want to point out that Nevada and Texas do require the PPP loans to be included in gross income. No, those are gross receipts taxes. It's not an income tax, so generally the rate is dramatically less than your income tax rate, but you do need to be aware of that. I guess you want me to talk about employee retention credit too, huh? Yeah,
that's you.
This is we've been doing so much of this, as many accounting firms have over the past 6 months. The big change was in December. Originally, you could not do an employee retention credit along and get a PPP loan, which ruled out vast majority of particularly smaller businesses. But then in December, they said that you could. So all of that just started rolling in. So we've been doing a lot of that over the past 6-7 months. Unfortunately, the IRS did kind of cause some problems with that, we'll say, because they were just silent on guidance on how to apply for the employee retention credit, how to differentiate between payroll that you used for PPP versus payroll you're going to use for the ERC. So we lost about 3 months of time there. Couple that with the fact that the IRS is woefully understaffed and woefully underfunded, meant that I've heard a couple anecdotal stories of companies receiving their refunds. We do have one, I'm aware of one company who filed in November. They did not take a PPP loan, so they were able to file for an employee retention credit in November. They only got a notice asking for more clarification before they could issue the refund in June. So it took the IRS more than 6 months just to get the notice out the door asking for more information. And refunds, both for the ERC and for everything, income tax, everything, have been very, very slow to come from the IRS. But Pennsylvania, Philadelphia, and most states, they follow federal. Indiana and Oregon did say that the wage deduction, they were going to allow that wage deduction. So that's a win in those couple states. But for federal and every other state, as you see on there, your wage expenses, you have to reduce them by the amount of the employee retention credit. So you do not get double the benefit there.
Yeah, so like you said, Mark, generally states are just going to follow federal and tax it. I think we tend to see a lot less states coming out with guidance when by default it's taxable. You see a lot less that want to actually decouple from that.
Yeah, gives them that political cover.
All right, so we're going to go into our first polling question. Mark, you want to sound the alarm for everybody?
I'm sorry, what did you say, Lindsay? Did you say polling question?
I did, Mark. We are going into our first polling question.
All right, first polling question.
If you could let us know, where are you joining us from?
All right.
Mark and I here are personally sitting here in Lancaster, our home office, but we have offices in both Camp Hill and Bloomsburg. So please make sure you're answering the polling question.
Yeah, I think we have here in Lancaster, we have what, 4 of us in here today?
It might be a record for the last year.
Yeah, there was one day, I forget what it was, but there was one day where we had like 7 people in the office, which was a record for the past year and a half. But next week we're coming back live, so office should be back in good shape.
Okay, hopefully you've been able to answer the polling question, and it looks like we've got the majority we've got from Harrisburg here today.
All right. Oh yeah, decent smattering all over the place.
Okay, so Mark, let me take you back in time for a minute here, okay?
I don't really want to. I want to fast
No,
forward.
we're gonna go pre-2020 now.
Oh, okay, all right, that's
So now, when it's not when people were mad about face masks or vaccines or anything like that, all right? People were angry about tax changes. So that's what I'm taking you back to now. So if you recall, back when the TCJA, the Tax Cuts and Jobs Act, was passed, it limited the state and local taxes that individuals could deduct on their personal returns to $10,000. And that sounds pretty high, but that's a big change for people in states with a high tax rate. So instantly the states reacted to this, and we saw them trying to create workarounds. One popular one was that you would have, like, New York created a charitable fund that you could choose to contribute to that and then get a credit for your taxes paid as if you were giving to the state out of the kindness of your heart. That was shut down by the IRS. They said that's, you know, clearly something that's actually a tax. It's just, you're just trying to call it charitable deductions because those aren't limited on Schedule A, whereas the taxes were. So the new thing now, on November 9th, 2020, the IRS issued Notice 2020-75, basically saying if you want to create a state level tax where it's at the entity level, we will allow that as a workaround to the SALT limitation. So states had already been trying this workaround. This was something you had started to see, but we didn't really know if it was going to fly until the IRS came out with this notice. So presumably that opened floodgates.
Yes, this is a huge deal. Little, like, going back in time, even though, like I said, I don't want to, but going back in time a little bit, yeah. This limitation served to, one, make a lot more individuals not itemize deductions because there was no benefit for it. They doubled the standard deduction, got rid of personal exemptions, which kind of served to not double the standard deduction, but whatever. Double the standard deduction, limited your state tax expense to $10,000. And so it kicked a lot of people just back under the standard deduction. And remember, when we say state and local taxes, we're not just talking about income taxes. We're not just talking about whatever's taxed on your W-2. We're also talking about real estate taxes. That was the other big thing here that really got limited, and really a lot of people lost a big tax benefit. Now, it was bad enough just on the standard individual who has a W-2, maybe 1099, whatever. But for flow-through entities, pass-through entities, partnerships, S-corps, LLCs, taxes, partnerships, this was just a massive hit because if you're an owner in any decent sized business, you're going to have a really large state income tax liability that you're paying personally. Obviously, most likely you're getting distributions from the company to cover it. But you lost the deduction on all of that, whereas the state tax deduction for C corporations is not limited. So this really was a big deal right from the beginning. So we weren't surprised when states started to try and get around it. But now they're going to that next level.
Yeah, and keep in mind, these are different from composite taxes, which is the entity paying tax on behalf of the shareholder, because that's still the shareholder paying tax and still would be subject to that limitation. This is sort of a new concept where the tax is paid at the entity level. It's imposed on the entity. So here is our summary. This is 20 states so far, which is just unbelievable how many states have quickly reacted to this and created pass-through entity taxes. Now, there are a whole lot of considerations. I actually had to split this onto more than one slide because, as with anything new that comes out, each state is doing whatever the heck they want. So we end up with a lot of different rules on these. So first on there you can see mandatory versus elective. Now the only state that I believe I've seen that's mandatory is Connecticut, and that actually started way back in 2018. So that most of them are elective, but even so, if they're elective and you decide to elect, is it revocable or is it not? Can you take it back or can't you? That's an important consideration as well. States have different deadlines, so you have to figure out, some of them do use the tax deadline, so you have to elect it by the time your tax return is due. Other ones do actually have during the year. So if you want to have the election for 2021 taxes, you would need to make that election now, not before the end of the year. Considerations about whether it's a one-time election or you have to do it every year. And then some of these limit the types of partners that can actually make this election. So certain, like I think California doesn't allow, if you have a pass-through entity that's a partner, you can't actually make this election. So there sometimes can be some potential tax planning around restructuring. This is something with all of these things to consider. I would highly recommend getting some kind of tax advice from a tax professional. It's one of those things that is just too complicated to try to tackle yourself. There's so many considerations, and every little detail of what your tax situation is going to matter in this case. Some of them do also have estimated payments required, so that's another thing to consider. You would actually have to pay those estimated taxes at the entity level, so you could potentially have those entity level estimated taxes and then also personal estimated taxes. So additional considerations. So some of these are about how this credit works. So some of these pass-through entity taxes give the owner a credit for the taxes paid on behalf of the owner for that entity. Others decide to just exclude the income that's passed through to the partner. So just kind of different ways that these are put into place. And then there might be different rules on if it's a credit, if that can be carried forward or not. The biggest issue probably on these comes down to whether you're going to get a credit for taxes paid to other states. So in other words, if I have an entity in New York and I decided to file it as a PTE tax, am I going to get a resident credit with Pennsylvania for that tax that I paid in New York? Because remember, it's an entity tax. It's not a composite tax, which is an individual tax anymore. It's an entity tax. So that was definitely questionable. But Pennsylvania did actually come out with some guidance on that, not anything official, but their customer service has a Q&A on this. And they've actually indicated that only S corporation shareholders will be allowed a resident credit and partnerships would not, which is kind of fascinating. Interesting where the logic came in there.
Well, that point, is that because that was already in there for S corporations? Or was that a new thing that they put in there as a reaction to this? Or was that just old law and they're just saying this is what the law says and they haven't addressed it yet?
The question came out in 2019, so it seems to be a reaction to these pass-through entity taxes, but before the IRS, gave the okay. So I can't say that things aren't definitely going to change potentially, but that was guidance that came out in reaction to these taxes.
Yeah, and if you look at the states that are doing this, they are all of the higher tax jurisdictions. The one notable absence, other than Pennsylvania, is New Jersey. New Jersey has a higher rate, so I don't see, but I don't see them doing anything yet. Oh no, I'm sorry, they aren't. No, I'm sorry, they started in 2020. That's why I was looking at the 2021. Yep. And good to see Oregon's doing something too, because they have a higher individual rate. But there's so many unanswered questions on this because I think there's going to be some legal challenges to this from states or somebody at some point in time, because the question in my mind comes down to to take a deduction for any expense, it needs to be legally your liability and you had to have paid it. So if it's not legally your liability, if it's somehow you chose to have the entity pay it instead of you paying it, is the legal liability still yours? Or has it actually shifted over to the company? And I don't know if we're going to get an answer to that until maybe a company elects to do this, but then the company can't pay. Who does the state go after? Do they go after the individual because it's a pass-through entity, or do they go after the entity itself? If they're able to go after the individual, then I think it's still the individual's responsibility, in which case I could see an argument saying you can't get a federal deduction for that. That's just one of the many unanswered questions here. And seeing as I'm guessing a lot of us pay tax in Pennsylvania, if you're an owner of a flow-through entity and you file in Pennsylvania and you're a Pennsylvania resident, all of your income is subject to tax in Pennsylvania. And then, like Lindsey said, you get a credit for your taxes paid to the other states. So the question is there, what benefit are we gonna get? Because you have to be careful, depending on how PA treats this, depending on what kind of entity you are. If you do this and pay the entity level tax then to the other states, then you're going to be paying that tax. But then if somehow it works out that you don't get a credit, an individual credit for those taxes paid to the other states, you could end up being taxed twice on the same income. So it is a little bit perilous of a journey here. And states have no skin in this. I mean, they're kind of like, whatever, we get our money either way. We want to take care of our residents and make sure they get federal tax benefits from this. So I would think that they would want to do this to make things easier, but who knows?
So we did get a question in, has PA adopted the PTE tax? And the answer is no. PA is not a state that has started using a PTE tax at this point. Not to say that they couldn't potentially in the future, but they are not one yet.
And with Pennsylvania's rate being only 3.07%, they weren't under a ton of pressure like New York was or California was, where the individual tax rates all in can get up, to like 11-12%, particularly if you live in New York City. They weren't under as much, or Pennsylvania hasn't been under as much pressure as some of these other states have been. But I could see them falling in line eventually.
Mm-hmm. So just to back up a little bit, Mark, because that was a lot of points. I know this is complicated stuff, like I said, but there's so many considerations. I mean, first and foremost, the reason it was created, which would be that SALT cap, would it help you get around that SALT cap? Is it deductible at the entity level? If it's an entity tax, are we going to even be able to deduct it there? You've got the resident credit considerations. Are you going to be able to actually take a credit for that tax? Because if you get a federal deduction, that's great. But then if you are limited in your resident credit, you have to actually figure out which benefit is going to benefit you the most. And then I think I passed over this the first time I was on this slide, but the rate as well, because the rates aren't always going to be equal. You might be paying a certain rate now on your personal return that you have to file in that state. Some of these PTE taxes, they do one flat rate. It might be higher than what you pay. It might be lower. You have to consider what you're actually going to be paying at that pass-through entity level.
Well, yeah, what if Pennsylvania does this and they say, since this is an entity level tax, you're going to be paying the corporate net income tax, which is 9.99%. So did you get any benefit there? I don't know. You just got to look at the numbers.
And then even for partners or shareholders, have they're in a non-tax jurisdiction where they don't pay any tax at the state level, there's still that indirect federal benefit. So even if you're living in Florida and you're paying income tax to New York, that PTE tax could be a benefit to you because then you're still getting that $10,000 SALT cap lifted in a way. And then the other consideration here, especially when you're talking about an election that isn't revocable, at some point, this SALT cap limitation is going to be gone. So that's another thing to consider. If you're doing it solely for the reason of getting that SALT deduction, I forget what is it, 2025, Mark? I think it phases out. And
well, that's what all of this is in reaction to something that under current law ends after 2025. Because this is all because of the Tax Cuts and Jobs Act and because of the way the Tax Cuts and Jobs Act had to be passed through budget reconciliation. They had to cut off all of the individual tax benefits at the end of 2025 to make the math work. Otherwise, they would have had to get 60 votes, and we all know they're not getting 60 votes. So yeah, all of this is in reaction to something that goes away in 3-4 years. So now they could conceivably at some point here extend the individual tax provisions or make them permanent. I mean, the political gymnastics you would have to do to get that, because you either have to pass it through budget reconciliation to not get 60 votes, and to do that you have to make sure you don't increase the federal deficit by a certain amount, which it most certainly would. So I'm not, particularly if you made it permanent, I guess you could do 5-year extensions at a time with only 50 votes through budget reconciliation. So there's the possibility that it will be extended. Yeah, under the current administration, it just won't be. And even under future administrations, even if the White House changes parties, because at some point here, the math just isn't going to work anymore to generate enough federal revenue to pay for everything.
And keep in mind too, some of these PTE regimes, they actually have an automatic phase out. So the PTE tax automatically ends when that SALT cap is phased out. So some of them have that built into the laws that they've created.
Which makes sense, assuming that the actual $10,000 cap goes away in 2026. But if they extend it, then I guess the states would just have to go back and remove that automatic end date.
All right, so I wanted to touch on working from home. So last year we kind of touched on this topic in this webinar and talked about how a lot of states were bringing up these exemptions from requiring people to file because you had an employee working from home, which makes sense because we had so many people who suddenly were working from home without planning to. So the states kind of gave people a break on that point. Well, that's kind of past due at this point. You have a lot of states now where those exemptions are expiring, or they had a certain end date. But the other thing, honestly, with the clients that I've talked to about this, most people, at least what I'm asked advice on anyway, is that they want to hire an employee in a different state. I'm seeing a lot of that, and I think it's hard to argue that that employee is working from home because of COVID when that is how you're hiring them. So I don't see a whole lot falling under the COVID exemptions anymore for those reasons. And that's really something that companies should really think about when they are hiring employees out of state. There's a lot of benefit to hiring employees in other states. As we know, there's a bigger talent pool. There's potential for, salary benefits there. But it really does have tax implications that, I'm not saying it should be the full decision, but it should be taken into consideration. If you're just looking at, say, an admin employee that wants to work from another state, it can have tax implications. So one of them is withholding, of course. That's generally across the board. If you have an employee in a state, normally you need to withhold unless there is some reciprocity there with your home state. And then income tax nexus, again, like if you have an employee in the state, normally that does cause nexus for both income and sales tax. The difference here and what generally needs to be thought about is, if you have nexus in that state, are you actually going to have any tax liability in that state? Because it's possible to have nexus, but when you actually file, it's going to be everything zero because that state uses just a single sales factor apportionment. So if that's the case, yes, maybe you are supposed to file if you don't have any liability, or you really, is it really worth filing if there's not really a tax liability there? And same thing with sales tax nexus. If you have an employee sitting in a state, you do have sales tax nexus, but are you selling something that's taxable? I mean, I think that's probably not a consideration generally for somebody that's selling something that's generally not taxable. But where you have to be careful is, you could be selling some kind of software as a service or, something that's not taxable in your home state. And guess what? It's taxable in that state where the employee just started. And that can actually change things. Again, it depends. You could already be over the economic nexus threshold, in which case it wouldn't matter. But there are situations where you have to be careful because having an employee does cause sales tax nexus in almost every state.
And one thing back to the income tax point, you have to be careful of, particularly with single sales factor apportionment now, being the vast majority of apportionment calculations in most states. I could see a scenario where a company has a lot of sales in, North Carolina, whatever, pick a state. But they've never had an employee there. They may have had salespersons which jumped through the hoops, so they didn't have to worry about income tax nexus there. But then all of a sudden they get a resume from someone who lives in North Carolina that's perfect for a position. They're willing to work with that employee to work remotely. So now all of a sudden you have income tax nexus in North Carolina. And now all of the sales, which previously you never were subject to tax in North Carolina because you didn't have income tax nexus, all of a sudden are. And maybe even if maybe you didn't even care before, because maybe it was 3-factor apportionment, which would keep your apportionment percentage low, but now single sales factor apportionment might change things. The other thing though to think about too is we've seen scenarios where companies go into other states and their total tax liability actually goes down, because this would most likely be in a C Corp scenario where you're paying tax, maybe you have 100% apportionment in Pennsylvania and you're paying 9.99% on everything. You go into another state and all of a sudden now you have nexus in another state, which means you can apportion in Pennsylvania and to that other state. If that other state has a lower tax rate, you're actually going to finish ahead. So it could work both ways for you.
Isn't tax planning fun? Don't go into the state. Do go into the state. I don't know.
Yeah. Well, that's why our answers are always, when the questions come up, the answers are, I don't know. We have to look into it and run the scenarios.
And I do touch there, while this is old news, but the home office deduction no longer exists at the federal level. Again, thanks to the Tax Cuts and Jobs Act. Pennsylvania does have a home office deduction. However, I do generally caution people, it's kind of difficult to get. And they actually came out with some guidance on this past year and even talked about if you do that, you have to allocate a portion of your utilities to it, and then you're supposed to pay sales tax on your utilities, and it gets a little funky. So unless you're really planning on taking a big deduction for that home office, I don't know if it's worth it at the Pennsylvania level.
Well, and I'm glad you mentioned that, because we got a lot of questions this past busy season from individuals saying, hey, I've been working, I got my whole home office set up here. I've been working home here for the last 6-9 months, so I want to take the home office deduction. And we had to break the news to them that for federal, there is no longer a home office deduction. In Pennsylvania, I don't know if we've seen this with the home office deductions for PA. I know for unreimbursed employee expenses, which are now non-deductible for federal too, deducting those for Pennsylvania. Pennsylvania was just disallowing them across the board, and you just get a notice saying that your income went up and now you owe this much tax, and then you have to dig into the numbers to figure out, oh, they disallowed my unreimbursed employee expense deduction. And then you have to contact the state, and then they're going to want receipts and everything. So PA is particularly good at creating headaches.
Yeah, they make it possible, but very hard. All right, now we're going to go into polling question number 2. So everybody, heads up, we are going into a polling question.
Ding, 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 polling question.
See, that's what I was looking for the first time, Mark, the little noise or something.
Yeah, sorry, I should have done that.
So what is your work from home status? Are you still at home? Did you ever go back into the office? Are you completely back in the office? Let us know.
Well, I never really left the office. It was lonely here for 6 months. What's that?
I never really came back. Today's sort of the odd day out.
Yeah. Yeah, we're definitely seeing an influx of people coming in here and across the board, people starting to get back to the office. So it's going to be interesting though to see how companies do this. With all of a sudden it's hey, you know what, we actually can work from home and be very productive and get stuff done. So we'll see how it goes.
All right, closing up that polling question. Looks like we've got a mix on those results. A lot of people, though, still working from home full time.
Yeah. Not a big surprise.
All right. All right, my favorite topic, Wayfair. So I'm not going to go over the whole history of Wayfair. Feel free, you can go to the macpass.com website. I've done several articles on this over the years. It's very interesting stuff. I mean, if you're not familiar with it, I would encourage you to look into it, not only because I think it's fascinating, but also just because you kind of need to know it at this point. It's becoming pretty important if you have anything where you have to charge sales tax. So these are just a couple of reminders. So don't forget, even though economic presence is the hot topic right now, physical presence still applies. So if you're stepping foot into a state, a lot of times that causes nexus. So don't forget, just because, you know, maybe you don't have 100,000 in sales into that state, you might still have that physical presence nexus. And it also just, it kind of increases focus. Make sure you're tracking those sales by state, because, you know, if the state does come after you, you need to have some records of that. And marketplace facilitator roles are always kind of evolving as well. So if you're selling through a marketplace facilitator, or if you're a marketplace facilitator yourself, you'll need to make sure you're aware of that. But I'm not going to cover all of that. That could probably be a whole webinar on its own as well.
And we have seen a few instances with companies who had plenty of sales to other states, and has always had plenty of sales to other states. They ship via common carrier or whatever, who never bothered to track it before because they never had any presence outside of Pennsylvania. Well, you got to track it now. So make sure you're doing that.
Yeah, because we're at the point now where, like I said, this is several years old. States are going to really start coming after this. I mean, you know, you might have had that grace period where they haven't really started enforcing it yet because it's new. I think those days are over.
Yeah, and it's a win-win for the state because they're getting more revenue and they're not making their residents mad because they're going after people who are outside of the state.
All right, so getting into the nitty-gritty details here. Most states, you know, you can see the vast majority there have gotten onto that bandwagon of 100,000 in sales and or 200 transactions in the state. We actually see less of those 200 transaction limitations, or what I've seen more recently is a lot more is just the and, rather than making it difficult, so that if you have, you know, if you sell 100 jigamabobs for $2 each into a state, then, or I'm sorry, the 200 for $1, whatever it is, then you're not having nexus on that $200 of sales. So most states did kind of drop that transaction limitation or made it an and, so you had to have both. Or the opposite way, where if you have one sale for a big amount into a state, that they're not imposing nexus on you for that, just that one sale. So you can see most states are under that 100,000. Kansas finally jumped on the bandwagon. They actually had it before, where the first dollar was subject to it. They didn't have a limitation, and they didn't really give a whole lot of guidance. They basically acted like, well, if you're selling into the state at all, you have to register and remit. So they finally jumped on board there. You can see Florida, Florida and Missouri were both holdouts here. They were ones that hadn't imposed it until recently. And you can see they have different dates for the actual implementation of this. Florida has said, although the date is 7/1, they've actually said they give you time to register until October 1st of this year. So make sure if you have those sales in Florida and you might have nexus, you're thinking about registering pretty soon here. And then Missouri, not until 2023. So they kind of pushed it down the road a little bit, but they did enact those rules. Tennessee is notable as well. They were 500,000 and they lowered now to the standard 100,000. So that's something to keep an eye out. If you are selling into Tennessee and had under 5 but over 1, that is something you want to look at. And then you've got various other limitations down there below. I'm not going to go through all of them, but you can see Arizona now in 2021, it's at 100 as well. You've got those few that are higher, but the general rule is, you know, look at your sales by state and see, you know, where your sales are at. I would go through, highlight any where you have over 100,000 in sales and start looking at, you know, is what I'm selling taxable? Am I required to register? So this is just a nifty little chart here. You can see since 2018, that was when Wayfair went through, you can see how quickly these states jumped on board. So everybody jumped right on board, and then you had a couple of stragglers who joined there up until now, where we have 47 out of 51 states that do have economic nexus rules in place. And those 4 states that are not included here, guess what? Those are states with no income or no sales tax, no sales tax. So, you know, if you have a sales tax, there is economic nexus in place. That's the rule now.
51 states?
DC. Don't forget DC.
Well, technically not a state.
All right, 50 states plus DC. So sorry.
I was just checking Twitter to see if I had missed some news.
You never know these days. But yeah, And those states would be, we've got Delaware, Montana, New Hampshire, and Oregon are the states that don't have a sales tax. Alaska also does not have a state sales tax, but they've even enacted this for its localities, which impose an income or a sales tax. Sorry, I keep getting those mixed up. But Alaska localities actually have a sales tax that is imposed. So if you're selling and enough things are being shipped to Alaska, you could potentially have to pay an Alaska locality sales tax. All right, so that's it for sales tax. I mean, I went over that pretty quickly, but it really is an important topic. So I want to make sure that is emphasized, again, because states are going to start enforcing these. And we'll get onto VDA'S in a little bit, and I'll talk about it a little bit more there, but just something to keep in mind. Make sure you are reviewing those sales and, you know, really considering whether what you're selling is taxable, because we've got a lot of digital things, a lot of software things, like things are taxable now that you might not have had to pay tax on before. So on to income taxes. For the most part, if you just have a salesperson going into the state and, you know, trying to get sales of tangible property, that was not, that PL 86272 was the law that said that you can't impose tax on that. So but it only applied to income tax was the important part. And that's where we get away with this for sales tax, because you don't have to, it's not protected under PL 86272. But with income tax, it is. What you have to be careful of now is what is tangible personal property. And I apologize, I wrote TPP there. I'm so used to abbreviating it, but it's tangible personal property. So it's goods, you know, it's things you can touch and feel. But it also now sometimes includes software and includes things that you wouldn't typically think of as tangible property. But PL 86272 does apply in that case. Again, you know, I'd require getting the help of a tax professional, because I can't really explain exactly when PL 86272 applies, because it's so specific on the situation that you really have to be careful. But basically, again, look at that 100,000 in sales in the state. If you reach that level, look at your sales tax, also look at your income tax, because that's something to consider when you're looking at where you need to be filing.
Yeah, I'm going to reiterate that point on 86272. It used to just kind of be, you know, if you're a tax geek like us, who pays attention to all these things, Public Law 86272 was something that you would just slap on tax returns all the time, to say, yeah, we have salespersons in that state, but they're following all the rules that have been laid out. They're allowed to do this. They're not subject to income tax, blah, 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 blah. Well, now it's are you selling more than one thing? Are you selling a widget, but then you're also installing that widget? Is the installation included with as part of the tangible personal property? What happens if you sell a paperclip, but then provide a ton of service that only applies if you buy the paperclip? Is that, you know, a workaround that people have tried to use? So yeah, just be careful. Like Lindsey said, you have to make sure it's tangible personal property, and make sure that what you're doing is exempt under that law before you start claiming it.
Yeah, when I'm assisting clients on this, we generally have a meeting, and, you know, I'm probably a little bit of a pain, to be honest, because I have to ask them so many questions on, you know, what it is they sell, just to make sure I fully understand, because the last thing I want is to tell you something is taxable and then it falls under some, you know, exception. So I always make sure that I'm really understanding, you know, what they're doing in each state, and making sure that it is something that doesn't fall under these rules. But you know, that it's just something to consider. And, you know, sometimes it does come down to a business decision as well. Like if you're in the state for, you know, 2 or 3 days a year, you know, is it something where you feel the need to file, or you want to kind of roll the dice and say, you know, it's not, we aren't there enough to really justify it. Technically, if you're there, you're there. So and then I just listed a couple of these local taxes. Things that aren't income taxes are not protected under Public Law 86272. So that's another thing to keep in mind. If it's not an income tax, it's not protected. So if you have this amount of sales that falls under these levels, then you do need to file. So I wanted to, as I kind of alluded to, I wanted to touch on these trends in data and digital goods and software because this is just growing and growing. I see more and more states passing these laws. Pennsylvania jumped onto this in 2016, 2017 and started taxing a lot of software services and digital goods and accessing software remotely, things like that. You really have to be careful about what you're doing in different states and whether or not that's considered taxable. Because again, you know, it might be taxable in one state, it might be exempt in another. Every state's rules can be different. One thing to note here, Maryland was the first to implement a digital advertising tax, which is, you know, something brand new, but they actually decided rather than incorporating it into the sales tax base, they made it a tax on gross revenue. So it's only applicable to companies with total gross revenues of 100 million or more at a rate between 2.5 and 10%. But large tech companies are challenging this tax because it is something brand new. So there is litigation involved here. So we'll have to wait and see what happens with that. And they have delayed implementation of this. It was going to be 2021. Now it's 2022, I think because of these challenges. So we'll see what happens. All right, so this brings us into our voluntary disclosures. So I'll just go over this quickly. A voluntary disclosure, if you look at your sales now and you realize, oh, we've had over 100,000 in this state, you know, for a couple of years now, and we didn't realize that we were supposed to file. A voluntary disclosure allows you to go to the state anonymously. So like I can contact the state for you, I can fill out the paperwork for you while keeping you anonymous. And basically, we will get an agreement that says we're going to remit the taxes that should have been paid, but they will allow you to get out of those penalties. So you won't owe the penalties on those taxes. So it really is a big benefit if you realize that, you know, something should have been done. And it's really nice that most of these you can do anonymously. So, you know, we can go in, we can get everything in line where it's supposed to be, and then you're good to go and can just do the right thing going forward. So I'd highly recommend this if, you know, you do that review and you realize you might have some outstanding liabilities. Voluntary disclosure is definitely the way to go.
And states are usually pretty willing to do this because it definitely falls into that category of, hey, state, you didn't know that these people should have been paying you, that this company should have been paying tax to you. We're here to come clean. And if you don't want to work with them, then they're probably just going to start filing today and moving forward, and you'll never know on the other taxes you missed out on. So they're usually willing to work with you.
Yeah, absolutely. And I would say you just got to be careful about choosing to just, you know, register going forward because, you know, once you do register, you're now ineligible for that voluntary disclosure. And if they do decide to come back and look at you, they can come after you for those past years if they realize you should have been filing, and then you're going to have those penalties. So generally, I'd say it's best to get on top of it and, you know, just do what you got to do and then come clean, and then you don't have to worry about anything. There's no issues down the road because this stuff can come into play down the road when you want to sell the company, and then there might be these outstanding issues where there's a exposure.
Yeah, that's a very important point. Don't contact the state on your own and just say, hey, here we are, because you lose 100% of your leverage if you do that.
Oh, please don't do that. That's a lot harder of a mess for me to clean up, let me tell you. All right, so with that said, we're going to go into the proposed budget. So this was introduced, this is for Pennsylvania. It was introduced on February 2nd, 2021, and it was signed by the governor on June 30th, 2021. So we do have a signed budget. It doesn't include the majority of these things listed here. So you see this proposed budget, and it is everything that Governor Wolf has been proposing for the last several years. So there's really nothing new on his proposed budget here. He's been trying to get the income tax rate increased. He's been trying to get the corporate rate increased. It's really nothing surprising, but almost none of it was passed. We do see the education investment. That was his big win this year, was he got the largest education investment in PA history. So that's where the money went at this point. One thing to note is that increase was for $300 million in basic education. Part of that education spending is an increase in the Pennsylvania EITC, or Educational Improvement Tax Credit Program. That got about a $40 million boost for a total of $225 million for next year. So if you aren't familiar with the Educational Improvement Tax Credit Program, we do have some articles and actually an informative video on our website for the Educational Improvement Tax Credit Program. Individuals can benefit from this. Basically, you give a contribution to an educational organization that qualifies and you can get a tax credit. So definitely something, if you're interested, to look into.
And historically, it's been hard to get approved for that, to break in for your first year if you've never done it before, because the entire budget was eaten up by companies that were already in the program. But with this increase for next year, I would think a lot of people will be able to get in now.
Yeah, I mean, $40 million more, so hopefully. One thing to note, this did go toward the scholarship organization program. So it's that part of the EITC specifically. So if you're applying and want to take advantage of this additional 40 million, you would have to apply for a scholarship organization specifically. And those they benefit the private school students K to 12. All right, so I just wanted to throw this in here. I'll go over this quick because I know we're getting short on time here. Here's the full budget. This was in the proposed budget. Generally, the part people focus on is this general fund here of 37.8 million. I think it might have been a little higher than that in the past budget. And then the other chart here, I just want to kind of show, this is the revenue makeup. And the interesting part that I always think is that corporate net income tax here only makes up 9%. When we have such a high corporate rate, it really doesn't make up that big a portion of our revenue. And then finally, how does PA compare? So again, I don't have a ton to say on this. Our overall rank last year was number 29. You can see we're number 27 this year. We did improve a little bit in the corporate rank. I'm not sure exactly where that came through. There weren't really Pennsylvania changes. I think that was just a result of other states moving up or down. New York did surpass California to be number 48 instead of 49 this year. So, you know, good for New York. They went up from the bottom just a little bit. And New Jersey's still down there at 50. Okay, and our final polling question. So everybody pay attention, get that last polling question so you get your CPE. What topic of these that we went over do you find the most interesting?
You know, Lindsay, I'm gonna give props to Dave on this one. You know, when Dave and I did these webinars, yeah, I mean, there were flyers references, there's Rowdy Roddy Piper references, there were ridiculous polling questions that somehow he'd find a way to like make fun of me in here, but you kept everything on topic.
You know what, Mark? I'm gonna stop you there for just a second because I had some wonderful COVID jokes in an original polling question, and unfortunately, they were too long to fit into the polling question. But I'll tell you one right now. Hopefully, you'll enjoy this. So I know when we initially thought maybe dogs could get COVID at some time, that was lifted, and the dogs that were in quarantine got released. So the World Health Organization said that it was okay for them to be released. So essentially, who let the dogs out?
Oh my gosh.
That was my favorite.
All right.
I'll stick to my day job. It looks like most people are interested in those PA updates and state comparisons. So good to know. I'm glad we try to focus on PA there.
All right. So one question that we did get was, what is they're asking about VDA'S and what is the first step in the process? Do they contact us or do they have to go out like to the state's website and pull a form down, or how does that work?
Yeah, so with the VDA process, absolutely contact us. I mean, we've done this before. We know exactly how to handle it. You can Google the state's VDA program. Generally, there's some kind of page on it if you want kind of an explanation of that state's program, but we're happy to explain it to you. We have experience with it. And again, do not contact the state is the most important part, because as soon as you're not anonymous, they can, do whatever they want. They can come after you for those penalties, but we'll keep you anonymous. We'll walk you through the process. figure out what you need to do. And you know, we can even, if it's something you're interested in, you know, we can even try to estimate what that liability is before we even go to the state.
And next question, is there a resource to say exactly what is subject to sales tax in Pennsylvania anywhere?
Well, there is a PA retailer's guide that can be helpful. You can just, again, you can Google that. It's very, very, very general. So you have to be really careful because, you know, you might find kind of a general topic that says taxable or non-taxable, but with sales tax law, there is so much that is nuanced in it and comes down to specific things. And then there are exemptions as well. So it gets pretty complicated pretty quick. If you want to go by a general rule, goods are generally taxable and services generally aren't. But as I've mentioned with Pennsylvania, a lot of software services and other things are, and like employment supply is a taxable service. Like there's random ones out there. So unfortunately, you can't really rely on a general rule, but you can look at that PA retailer's guide, and there's also a contractor's guide out there. Again, feel free to reach out to myself. My email's right up there on the screen. I can, you know, send you some of this information. I'd be happy to, but if it's something really specific that you're looking at, I would recommend getting advice.
All right, cool. All right, looks like that's it for the questions for today. Thank you everyone for joining us for our webinar today. If you have any further questions, feel free to reach out to us and we're happy to help you out. A recording of today's presentation will be posted on our website and social media sites in a few days. For those of you who requested CPE and answered the polling questions, those certificates will be sent out within the next 2 weeks. Thank you again for joining us, and I hope you all have a wonderful rest of the day.